this is going to be a significant impact. And a lot of these refineries in the Great Lakes, the Midwest, the Rockies process Canadian heavy oil almost exclusively. So right now, Western Canadian Select, which is one of the benchmarks, at about $60 a barrel, that 25% tariff would amount to about $14 or $15, which break it down to a gallon of gasoline. And the raw input would be about a 33, 34 cent a gallon impact. And so this is not nothing. I mean, this is an over 10% impact. And this is the baseline would be about 35 cents. Keep in mind, 25% tariff. If oil prices rally, you're going to see that tariff go up and up and up. And it's going to be more of a squeeze as that happens, especially into the summer months.
Well, that's a very good point. Of course, this kind of policy can't actually be implemented until at least January 20th when Trump takes office, which is just over a month and or I guess 2 months from now, just a little bit less than 2 months. Where are we going to be in terms of gas prices by then, Patrick, considering the trajectory we are currently on, which has been pretty steadily lower?
Well, I think most consumers are going to feel that bite very significantly because over the next couple of months, we should see gas prices staying at relatively low levels. We still should have half of the country, if not more, seeing average gas prices below $3. For comparison's sake, GasBuddy counts about 30 states today below $3 a gallon. And though there may be some volatility in prices, depending on, the balance of global supply and demand, depending on Russia and Ukraine and the Middle East, there may be some minor fluctuations, but the seasonal low should stick around right through Inauguration Day. And if we see that tariff implemented, it's going to be a rather abrupt pinch at the pump for those areas that are going to be affected.
Would that theoretically, and I understand we're playing in hypotheticals here, but would that lead to a just as abrupt drop-off in demand?
Well, it probably wouldn't lead to such a drop-off. I mean, Americans only really have their car to drive, whether it's an EV, then they're insulated completely from this. But for those that are still driving around an internal combustion engine vehicle, there's not a whole lot of alternatives here, nor are there really alternatives for the refineries that have for decades been relying on Canadian crude oil. This is upsetting the status quo that's been established really for probably the better part of 100 years. These refineries have processed Canadian oil almost exclusively, and they're going to be the ones impacted the most. And they really have no alternatives, as Bod has said. These inland areas, Illinois, Michigan, Ohio refineries in this region just really don't have alternatives.
Well, so explain that to those who might say, hey, Donald Trump has promised to deregulate American energy, to make it easier for them to build out new infrastructure, to increase their production capacity. That's going to mean we produce more, and potentially that means prices go lower. Why is that not true when we think about the need to potentially directly replace some of these imports?
Yeah, I mean, absolutely. I mean, you're talking about a huge change in the status quo. I mean, a president that would potentially on day one levy massive tariffs is not something we're used to a president seeing. And so, I've heard folks say, well, how can the president have such a vast impact? Well, because presidents typically don't upset the status quo in such a huge way. And these refineries have long for, as I mentioned, decades been set up. They've been configured specifically to process more of this heavy Canadian oil. They have additional units, coking units, desulfurization. I mean, they have decades of experience processing Canadian oil and specifically designing their refineries around this type of oil. Keep in mind the largest refinery in the Midwest, 435,000 barrels a day down in Whiting, Indiana. That's Northwest Indiana. In 2008, spent $3.5 billion, essentially making itself more reliant on processing more Canadian crude oil. So, I mean, that's just how reliant these refineries are. There's been a steady supply of Canadian oil, an increasing amount for decades and decades. We're now receiving 4 million barrels of Canadian oil a day. So this is a drastic and sudden potential shift.
Well, so when we consider the refiners, obviously we have to take into account refining margins here. And as we consider tariffs especially, we have heard this notion propagated by Trump and those who think similarly to him, this idea that not all tariffs are necessarily a direct cost that the consumer will pay. Companies could eat some of this, for example. Could we see instead of it being passed on to the end consumer at the gas pump just a shrinking of refining margins, or are they likely to want to pass all of that additional cost on?
Well, refinery margins are already at some of the worst levels we've seen in multiple years. I mean, refineries probably in this region are only clearing a few dollars a barrel. So, can they absorb some of it? Maybe, an iota of it. But for now, refining margins, I mean, this is the time of year that they are very much challenged. And keep in mind, the irony here is the only way that these refineries have been profitable is because Western Canadian crude oil generally comes to the US at a pretty big discount because of its landlocked status. Now, the interesting dynamic here that few people are talking about is at the same time these tariffs could be implemented, Trump may again greenlight the Keystone XL pipeline, which ironically could give Canada exactly what it wants. Is it wants another market besides U.S. refiners. And so if the Keystone
Mm.
XL is suddenly greenlit, that could essentially give a huge win to Canada, allowing a lot more of that Canadian heavy crude oil to be exported. And it could further inflict more pain on refineries down in the U.S., which are already dealing with razor thin margins.